What if I told you the real winner from this Elon Twitter deal isn't Elon? This deal is amazing for a completely different group of people. Elon, he's spending $46.4 billion to buy a problem that needs fixing, while others will sit back and let the cash roll in. And one of these people could actually be you. But before we get into who wins, we need to understand, how much does Twitter profit? I mean, is this even a remotely good deal? Ever since its IPO, investors from around the world have called Twitter everything from investing at its worst, a poor performer, other billionaires regret investing, and an outright lousy place to put your money. Is Elon just buying a turd, or is there something more here? Well, I'll let the numbers show for themselves. Twitter does have healthy sales growth, but actual profit, cash in your hand, this has always been a problem. And this has led to the unanimous question of how in the world is Twitter still not making any money? Now, to be fair, they did turn a profit in 2018 and 2019, but that soon reversed in the years following. I mean, if we look on the bright side, they're trending in the right direction, but they're still down 200 million last year. This is going to be quite the uphill battle. But what's the problem? I mean, Twitter's massive. Celebrities use it. Presidents use it. Okay, either way, nearly 400 million people use this platform and sales are growing. This is a mature company. It should have some profits. Well, two major things stand out to me. They spend a whole lot on research and development and even more on staffing. Also, they killed Vine.
This kid's definitely on crack right now.
Yeah!
In its current state, Twitter literally won't be able to make the debt payments that are created through the buyout. It would either have to take on even more debt or deplete their cash. Now, Musk does have some wild ideas on how he's going to make that happen, but first let's break down this $46.4 billion leverage buyout. And what is a leverage buyout, you might be asking? This is a fairly common but genius way to purchase a company while limiting the risk of the buyer. Basically, a leverage buyout is a purchase through both cash and new debt. And you might be thinking, sounds just like a loan. You put up some money, the bank puts up the rest, and you'd be right. Except in a leverage buyout, you don't personally take on debt. The company you purchase is taking on the debt for you. It doesn't even seem possible if you're not familiar with it, but I've actually seen this done with small businesses as well. Let's say a business is selling for $1 million and a bank determines, hey, it looks like a pretty good deal. You could structure that deal so you pay something like $500K up front, and then the other $500K is a loan where the collateral is actually the company that you're buying. This is what Musk is doing, but it's even more interesting than that, because when you're the richest man in the world, normal deal structure just goes out the window. You can do whatever you want. So we have this $46.4 billion total. $13 billion will come from 7 large banks backing Elon in the deal. This $13 billion is broken up even farther into 4 additional categories. One of those in particular is fascinating to me, the $3 billion. Name someone else in the world who's able to get $3 billion in unsecured debt lined up in less than a month's time. This is insane. Back to the total deal, $46.4 billion total, $13 billion from banks. Then we have $12.5 billion in loans back from Musk's personal Tesla stock. This is called a margin loan. Anyone can actually do this type of loan, but like 5 people in the world could do one worth more than $10 billion. This leaves us with $20.9 billion to spare that Elon needs to come up with in order to actually close the deal. This can happen in a variety of ways: finding additional investors, allowing current shareholders to convert over, or doing the entire deal himself, which he actually could feasibly do. But there's a problem here.
This is not a way to sort of make money. Having a public platform that is maximally trusted and broadly inclusive is extremely important to the future of civilization.
The pool of investors looking to help free speech is surely smaller than the pool looking to make a profit. However, Elon is Elon, and if someone can make this deal happen, it's definitely him. And it turns out he's already raised more than $7 billion of that, including $1 billion from Larry Ellison, the founder of Oracle, and the man with the most debt in the world. So Elon just might make this work. Plus, he does have ideas on how to turn this ship around by cutting costs and making more profits than ever. And this is important, so let's talk about it before we get into who's cashing in on this deal big time. One idea is to drop executive pay. This would result in about $3 million in annual savings, hardly a dent in what will soon be hundreds of millions in debt payments. Beyond this, his ideas become a little bit less clear, which again is completely wild. Think about what you typically need to do to get a business loan. You need this well thought out plan, maybe a SWOT analysis like they teach you in business school. Apparently, Elon gave very little detail on what he's going to do, and he organized the 4th largest take private deal in history all in less than a month. The world's biggest banks are literally like, this Elon fella, he knows how to make money better than the rest of us. We'll just take his word for it. However, we have heard hints of other ways Elon might try to go ahead and generate revenue. He's mentioned trying to find ways to monetize viral or important tweets and charging a fee when third-party websites use those tweets on their content, adding in a verification service for $1 a month to both drive revenue and help get rid of the pesky bots that are on literally every platform now. Watch out for those in the comments. And then there's Dogecoin. In a now deleted tweet, Elon mentioned allowing people to pay for Twitter Blue, the premium service, in Dogecoin. So all in all, Elon wants to lower Twitter's dependence on advertising, which may be necessary if content moderation is also lowered. And he feels that there's a ton of room for cost savings as Twitter's biggest competitors like Meta have much, much healthier gross margins. And we may see changes to the actual service as well.
Technical changes that Musk has tweeted about are things like adding an edit button, making tweets longer, and stopping spam bots, making the platform's algorithm open source, and softening the company's strict content moderation policy.
Okay, sorry, just woke up. Some more news came out about Elon's plans as I was working on this video. So he gave some more specifics, like his plan to 5x revenue, increase Twitter's payments business, double users, and get 104 million subscribers to this secret new product called X. Cool, let's get back into it. And we know how the deal's structured, the problems Musk faces, and the changes he's looking to make. Kind of. So who's set to make the most from this deal, and how do you actually profit from all this chaos? Of course, you have existing shareholders who before Elon's offer saw shares at about $45, meaning the deal would net them an instant 20% return on their shares. But this is only the tip of the spear. Twitter's former executive chair will receive over $50 million thanks to his shares. Co-founder Jack Dorsey will net nearly $1 billion in profits thanks to his 18 million shares. And the big investment giants, of course, will get their cut of the action. $2 billion to both State Street and BlackRock, $3.5 billion to Morgan Stanley, and $4.5 billion to Vanguard. Now, it's fairly obvious that people owning the stock will benefit, but it goes far deeper than this. Take the current CEO of Twitter, Parag. Thanks to his employment contract, he will receive $38.7 million in compensation if he loses his job, which it looks like he's going to. Not bad for a job he's had for about 6 months. It's looking like Elon will be the temporary CEO after this deal is made, which is especially insane because this would mean Elon is the CEO of 3 different multi-billion-dollar companies at the same time: Tesla, SpaceX, Twitter. But who else stands to make massive money thanks to this deal? As always, the bankers. Morgan Stanley is advising Musk while Goldman Sachs is advising Twitter, and both stand to make a ton of money. But this is a weird kind of love triangle type of deal because both investment banks have a long-time relationship with Musk. They both underwrote Tesla's 2010 IPO. And if you remember earlier, Morgan Stanley, because they're one of the largest shareholders of Twitter, is set to net $3.5 billion thanks to stock appreciation. Picture that. Imagine you own 8.5% of a business, and then someone pays you to advise them to buy your business.
What?
As time goes on, I realize more and more that business is just literally imaginary. Now, we don't have the exact payouts for these banks, but these are typically structured as a percentage of the deal. And remember, this is the 4th largest private takeover ever. As Twitter's advisor, Goldman will get paid no matter what, but will make much more on fees if the deal actually goes through. Morgan Stanley will only get a significant payday if the deal is successful, but for a deal this size, both banks would typically receive about 1% of the total purchase price of the entire business. That works out to a payday in the neighborhood of $460 million for both Morgan Stanley and Goldman Sachs. Not bad for a few months of paperwork. Now, there is an angle that you can take here individually to potentially cash in on the deal. The market hasn't fully priced in the acquisition because we can't say with 100% certainty it'll go through. Is it likely? Yes. Is it certain? No. Because of this, we've seen shares of Twitter floating around $50, even though the take private price is $54.20. This means you can bet on the deal going through, and if it happens, you'd land a nice 8 to 10% return straight from Elon's pocket. Of course, the downside here is if the deal doesn't go through, you'll risk your shares going down in value. However, both Twitter and Elon have huge incentives for the deal to go through at this point thanks to a termination clause. According to their SEC filing, if either party terminates the deal, they'll have to pay a $1 billion fee. Do you actually think this will go through? Is this the ultimate degen investment for Elon? Let's chat about this in the comments.